Taxes. Imagine waking up after working a brutal week at your job. Long shifts, sore back, exhausted mind. You finally get paid. Your paycheck says $2,000, but when you check your bank account, only $1,456 actually arrives. The rest vanished before you even touched it. Federal tax, state tax, Social Security, Medicare. Tiny percentages slicing pieces off your paycheck like invisible scissors. Welcome to taxes, the system where governments take part of your money before you even get the chance to spend it. At its core, taxes are the price people pay to live inside organized societies. Roads, schools, hospitals, police, firefighters, electricity grids, public transportation, food inspections, military defense. Governments need money to run massive systems, and taxes are how they collect it. But the frustrating part is that taxes don't stop at your paycheck. They hit you from every direction. Income tax takes money when you earn it. Sales tax takes money when you spend it. Property tax charges you for owning things. Capital gains tax taxes your investments when they grow. Even death can trigger taxes in some countries. Then there's Social Security and Medicare taxes. Social Security is basically forced retirement savings controlled by the government. You pay into the system while working, and later in life, you receive monthly payments back. Medicare helps fund healthcare systems for older adults and people with serious medical needs. Whether you personally use those systems now or not, your paycheck helps support them. And then comes tax season, arguably one of humanity's strangest rituals. The government often already knows roughly how much you owe. But instead of simply telling you, it makes you calculate it yourself. If you make a mistake, penalties appear. If you underpay, they come for more. If you overpay, congratulations, you gave the government an interest-free loan until they decide to refund it. Some people pay taxes automatically through payroll deductions, others pay quarterly, and some avoid taxes entirely until their life becomes a Netflix documentary. Still, despite how annoying taxes feel, societies with strong tax systems often have better infrastructure, healthcare, education, and quality of life overall. Taxes aren't designed to feel good. They're designed to keep giant civilizations functioning. Banks. Most people think banks are giant vaults quietly protecting everyone's money. You deposit cash, they lock it away safely, and it waits patiently until you return. But that's not how modern banking actually works. The moment you deposit your money, the bank immediately starts moving most of it somewhere else. Banks operate on something called fractional reserve banking. Instead of keeping 100% of everyone's deposits sitting inside vaults, they only keep a small percentage available at any time. The rest gets loaned out to businesses, homeowners, students, or someone financing a jet ski they absolutely cannot afford. Your deposited money becomes fuel for the entire economy. Here's why that system usually works. Not everyone withdraws all their money at the same time. Banks rely on trust and probability. They assume most people will leave their money untouched while only a small number make withdrawals daily. But if everyone suddenly panics and demands their money back simultaneously, the system cracks. That's what happened during financial crises like 2008, when fear spread faster than banks could supply cash. Banks make profit through interest. They pay you a small amount of interest for storing money with them, then lend that same money to others at much higher interest rates. The difference between those two rates becomes profit. In simple terms, banks are middlemen connecting people with extra money to people who need borrowed money. So why do people still use banks? Convenience is one reason. Carrying cash everywhere is risky and inefficient. Digital payments, cards, and transfers make spending easy. Safety is another reason. In countries like the United States, deposits are insured up to certain amounts, meaning even if a bank collapses, the government guarantees most people won't lose everything. Modern banking runs almost entirely on trust. Trust that numbers on screens represent real value. Trust that your money will still exist tomorrow. And as long as society believes that system works, the entire economy keeps moving. Interest. Interest is one of the most powerful forces in finance because it quietly controls both wealth and debt at the same time. At its simplest, interest is the cost of borrowing money. If someone lends you cash, they expect extra money back later as payment for waiting and taking risk. Imagine borrowing $1,000 and paying back $1,280 as interest. It's essentially money charging rent for existing inside someone else's hands. When you borrow money, interest works against you. When you save or invest money, interest works for you. There are two major forms: Simple interest stays predictable. You pay a fixed percentage based only on the original amount borrowed. Compound interest is where things become dangerous or incredibly powerful, depending on which side you're on. Compound interest means interest itself starts generating additional interest. Your debt grows on top of previous debt, or your investments grow on top of previous growth. This is why credit card debt becomes terrifying so quickly. A small unpaid balance snowballs month after month until a simple purchase becomes massively overpriced. Miss payments, and suddenly interest begins multiplying faster than expected. Tiny financial mistakes slowly evolve into long-term burdens. But compound interest also creates wealth. Invest money consistently over decades, and the same mathematical force starts working in your favor. Small investments grow larger. Then those gains generate more gains. Eventually, the growth itself begins accelerating. That's why many wealthy people aren't necessarily financial geniuses. They simply understood how powerful time and compound growth become when combined. Interest is neither good nor evil. It's a tool. When you owe it, it drains your future slowly. When you earn it, it builds your future quietly. Understanding that difference changes everything financially. Inflation is the reason your favorite snacks get smaller, while prices somehow keep getting bigger. Your money still says the same number on paper, but its actual purchasing power slowly shrinks over time. A $5 bill today simply cannot buy what it could years ago. At its core, inflation happens when prices across the economy rise gradually. Sometimes this occurs because too many people are trying to buy the same limited products. Businesses notice high demand and raise prices because customers are still willing to pay. Other times, inflation comes from supply problems. If fuel, shipping, labor, or raw materials become more expensive, companies increase prices to protect profits. Psychology also plays a role. If people expect prices to rise soon, they spend money faster now. That increased spending creates even more demand, which pushes prices higher. One of the biggest drivers of inflation is money creation itself. Governments and central banks can create new money digitally or physically. When huge amounts of money enter the economy too quickly, each individual unit of currency becomes less valuable. Imagine cutting a pizza into 8 slices. Now imagine doubling the number of slices without increasing the amount of pizza itself. Each slice becomes smaller. Inflation works similarly with money. Moderate inflation is considered normal in modern economies. In fact, central banks often intentionally target small inflation rates because mild inflation encourages spending and investing instead of hoarding cash. But high inflation becomes dangerous very quickly. Prices rise faster than wages. Savings lose value sitting in bank accounts. Everyday necessities become harder to afford. In extreme cases, hyperinflation can completely destroy currencies. History has seen moments where people needed wheelbarrows full of cash just to buy basic food. Inflation quietly affects nearly every financial decision humans make: salaries, housing, savings, retirement, investments, and future purchasing power. Money itself is never perfectly stable. Its value constantly shifts depending on trust, supply, production, and economic confidence. Credit scores. Imagine having a hidden financial reputation score attached to your identity, a number that influences whether banks trust you enough to lend money, finance a car, approve a mortgage, or even rent you an apartment. That sheer, essentially what a credit score is, a system designed to predict how likely you are to repay borrowed money. The higher the score, the safer lenders believe you are. Credit scores are built from financial behavior over time. Paying bills consistently helps. Missing payments hurts. Carrying large debt balances lowers scores. Long histories of responsible borrowing improve them. Every loan, payment, missed deadline, and credit card balance quietly feeds into the system. In countries like the United States, giant credit bureaus collect enormous amounts of financial data and transform it into scores using algorithms. Here's the strange part. Using debt responsibly can improve your score. Completely avoiding credit cards and loans may leave you with little financial history at all. In other words, the system often rewards proving that you can manage debt, not necessarily avoiding debt completely. A strong credit score can save enormous amounts of money over time through lower interest rates, easier approvals, and better financial opportunities. A weak score does the opposite: higher rates, more rejections, and greater financial stress. Small financial mistakes can follow people for years: missed payments, loan defaults, Maxed out credit cards, even applying for too many loans too quickly, can temporarily damage scores. Credit scores aren't moral judgments. They cheese statistical risk tools, but because modern life depends heavily on borrowing, these numbers quietly shape millions of people opportunities. Debt is one of humanity's oldest financial systems. Thousands of years ago, people borrowed grain, livestock, tools, or precious metals. Today, people borrow digital numbers on screens. But the core idea never changed. You receive resources now in exchange for repayment later, usually with interest attached. Debt itself isn't automatically bad. Modern economies actually depend heavily on it. Businesses borrow money to expand. Governments borrow money to fund infrastructure. People borrow money to buy homes, cars, education, or survive emergencies. Used carefully, debt acts like a tool that allows people to access opportunities earlier than they otherwise could. But debt becomes dangerous when repayment grows faster than financial stability. Credit cards are a perfect example. At first, they feel harmless. Swipe, now pay later. Tiny monthly minimum payments make balances seem manageable. But interest quietly compounds in the background until temporary convenience transforms into long-term obligation. Student loans create another unique form of debt. Young people borrow huge amounts of money before fully understanding the long-term consequences. Then they spend years or decades repaying education that was supposed to create opportunity. Mortgages create the largest debt most people will ever carry. A house might technically belong to the bank for 30 years while you slowly buy it back piece by piece. Debt also creates psychological pressure, financial anxiety, constant stress, and feeling trapped in jobs or situations simply because the payments never stop coming. Entire industries profit from keeping debt active as long as possible through minimum payments, refinancing, and rolling balances forward month after month. The system earns more money when debt survives longer, but debt can also create growth. A business loan can build a company. A mortgage can create home ownership. Education loans can sometimes increase future income far beyond the original cost. The difference lies in whether debt creates future value or simply finances temporary consumption. Debt is powerful because it allows humans to borrow from their future selves. The danger comes when the future eventually arrives. Insurance is basically organized risk sharing. Humans realized long ago that disasters become easier to survive when large groups share the financial burden together. Imagine a village where one farmer loses a barn to fire. Rebuilding alone could financially destroy that family. But if the entire village contributes small amounts regularly, the loss becomes manageable. Modern insurance works similarly, just at massive scale, using mathematics and probability. Millions of people pay relatively small premiums into insurance companies. Most people won't experience disasters at the same time. That allows insurance companies to use pooled money to cover the smaller number of people who actually suffer losses. Car insurance helps pay for crashes. Health insurance helps cover medical costs. Home insurance protects against fires, storms, and disasters. Life insurance supports families after death. Insurance companies constantly calculate risk using age, driving history, location, health, and even lifestyle choices. The riskier you appear statistically, the more expensive insurance becomes. Insurance companies survive because probabilities usually work in their favor overall. They collect more in premiums than they expect to pay out in claims. But when giant unexpected disasters happen, hurricanes, pandemics, economic collapses, insurance systems can become unstable very quickly. That's why governments sometimes step in to stabilize insurance markets during major crises. The strange thing about insurance is that people pay for protection hoping they never actually need to use it. Ideally, you lose money on insurance forever because nothing terrible happens. But when catastrophe strikes, insurance can mean the difference between recovery and total financial ruin. Investing is the process of using money to try growing more money over time. Instead of simply storing cash, investors place money into assets they believe will increase in value later. Stocks, real estate. Businesses, bonds, commodities like gold or oil, even art, collectibles, and digital assets can become investments if people believe their future value will rise. The basic idea sounds simple: buy low, sell high. But reality becomes much more complicated because nobody can perfectly predict the future. Markets constantly move based on human emotion, economic conditions, fear, optimism, wars, technology, politics, and unexpected global events. Prices rise when people believe value will increase. Prices crash when fear spreads faster than confidence. That's sure why investing is deeply psychological. Humans panic during crashes. Humans become greedy during booms. Entire bubbles form. When excitement disconnects prices from actual value. History is full of examples. Tulip mania, the dot-com bubble, the 2008 housing crash, cryptocurrency volatility. Every generation eventually believes it discovered a guaranteed investment opportunity, then reality eventually returns. Long-term investing, however, often depends less on prediction and more on patience. Broad markets historically tend to grow over long periods because businesses continue producing goods, services, and innovation. The process is messy. Crashes happen, recessions happen. Fear spreads constantly, but historically, economies continue expanding over long enough timeframes. That's sure why time becomes one of the most important parts of investing. The longer money stays invested, the more compound growth can work. Investing is ultimately a bet on the future, a belief that businesses will continue building, technology will continue advancing, economies will continue functioning, and human civilization will keep moving forward despite chaos along the way. Recessions. A recession is basically a period when the economy slows down significantly. Businesses earn less money, consumers spend less, hiring slows down, unemployment rises, economic activity shrinks across entire industries. Technically, economists often define recessions as multiple quarters of declining economic growth. But for ordinary people, recessions feel much simpler. Life becomes financially harder. Companies become cautious because they fear lower profits. Consumers spend less because they fear uncertainty. That creates a chain reaction. Less spending means less business revenue. Less revenue leads to layoffs and budget cuts. Layoffs create even less consumer spending. Fear spreads through the economy almost like a virus. Some recessions begin naturally after periods of excessive growth or speculation. Others begin after major shocks like wars, pandemics, banking failures, or energy crises. The Great Depression became one of the worst economic collapses in modern history. The 2008 financial crisis nearly collapsed major banking systems. The COVID-19 pandemic triggered sudden economic shutdowns worldwide. Governments and central banks usually respond aggressively during recessions. Interest rates may be lowered to encourage borrowing and spending. Governments may inject money into economies through stimulus programs. Banks may receive emergency support to prevent collapse. Sometimes these interventions help stabilize economies quickly. Other times recovery takes years. Recessions feel terrifying because they expose how interconnected modern economies really are. One industry slows down. Suppliers get hurt. Workers lose jobs. Spending falls elsewhere. The ripple effects spread outward continuously. But recessions also eventually end. Economies recover. Businesses adapt. New industries emerge. Human systems rebuild. Economic history is essentially a repeating cycle of growth. Collapse, recovery, then growth again. Money, humans spend most of their lives chasing it, worrying about it, protecting it, and fighting over it. Yet money itself is strangely artificial. A dollar bill is just paper. Numbers inside bank accounts are just digital records. Money only works because humans collectively agree it has value. Long ago, people traded directly through barter. Grain for livestock, fish for tools. But barter becomes complicated quickly. What if the person with cows doesn't need your wheat? Societies eventually needed a universal medium of exchange. Something portable, durable, difficult to fake, easy to divide and trade. Precious metals like gold and silver eventually became popular because they fit those requirements well. Gold had value partly because it was rare, difficult to mine, and widely trusted. Paper money originally represented actual gold stored somewhere else. People could theoretically exchange paper currency for real gold held in reserves. But modern currencies mostly abandoned the gold standard long ago. Today, most money is fiat currency. Its value comes primarily from government backing and collective public trust. If society trusts the system, money functions smoothly. If trust collapses, currencies can become worthless frighteningly fast. That's sheer why central banks become extremely important. Central banks control interest rates, regulate money supply, and attempt to stabilize economies during crises. Institutions like the Federal Reserve influence global financial systems constantly. When central banks create too much money recklessly, inflation can spiral out of control. When they restrict money too aggressively, economies can freeze. Modern economies are basically giant balancing acts built on confidence, and money sits at the center of all of it. The stock market? The stock market is basically a giant global system where pieces of companies are constantly bought and sold. When you buy a stock, you cheer purchasing tiny ownership in a business. If the company grows and becomes more valuable, your shares usually become more valuable too. If the company struggles, your investment can shrink rapidly. At first glance, the stock market seems logical. Successful companies rise, weak companies fall. But real markets are heavily influenced by psychology, speculation, and emotion prices. Move not only on reality, but on what humans believe reality will become later. Investors constantly try predicting the future before everyone else. Will a company grow? Will new technology dominate? Will a recession arrive? Will governments change policies? Because millions of people speculate simultaneously, markets become incredibly volatile. Prices can surge irrationally or collapse suddenly in panic. The market crashes of 1929, 1987, 2000, and 2008 showed how quickly optimism can turn into fear. During bubbles, investors often convince themselves prices will rise forever. Then reality eventually breaks the illusion. Yet despite crashes, the stock market has historically trended upward over long enough periods. Businesses continue producing goods, services, technology, and innovation. Entire industries evolve over decades: railroads, automobiles, computers. The internet, artificial intelligence, the stock market ultimately reflects collective human belief about the future. Sometimes those beliefs are accurate. Sometimes they become dangerously detached from reality. But as long as humans continue building companies and economies continue functioning, markets continue moving forward.